If you have a pension, the IRS treats you completely differently than every other retiree in America. Different from the person with a 401k, different from the person living on Social Security alone, different from the person with a brokerage account. And almost nobody, including most accountants, understands what that actually means for your tax bill. Here is what I want you to think about. Only 14% of private sector workers still have access to a real pension. 86% of state and local government workers do. So, if you are watching this video and you have a pension coming, you are in a very small, very specific group. The strategies that work for everybody else, the rules of thumb you read in retirement books, the 4% rule, the standard withdrawal sequence, almost none of it was written for you. I am going to walk you through 6 things the IRS does to pension holders that nobody's talking about. By the end of this video, you will understand exactly why your pension changes the math on Social Security taxation, on Roth conversions, on Medicare premiums, on state taxes, on required minimum distributions, and on the lump sum versus monthly payment decision that almost everyone gets wrong. Type pension in the comments if you have a pension coming or are already collecting one. Just yes or no. This tells me which video to make next. Let me be clear. Nothing in this video is legal, tax, or investment advice. These are educational examples based on current tax law. Always consult a qualified tax professional for your specific situation. Stick with me, because the first thing the IRS does differently surprises pension holders the most. Number 1, the IRS treats your pension as fully taxable ordinary income, every single dollar of it in most cases. People do not realize this. They think because they paid into the pension during their working years, the money they receive will be at least partially tax-free coming back out. That is not how it works for the vast majority of pensions. If your pension was funded entirely by your employer with pre-tax contributions, every dollar you receive in retirement is taxable as ordinary income at your federal marginal tax rate, not capital gains rates, not some special pension rate. Ordinary income, the same way wages are taxed. If you contributed after-tax dollars to your pension during your working years, you get a small portion back tax-free using something called the simplified method. But for most public sector pensions and most private pensions, the percentage of your benefit that is tax-free is small, often less than 10% of each payment. Here's what that means in practical terms. Say you are receiving $36,000 a year from your pension. At a 12% federal bracket, that is about $4,300 going to the IRS. At 22%, it is closer to $7,900, and that is before state taxes touch it. If you are still watching, you want the real answers. Number 2 is where geography costs you thousands. Number 2, your state of residence matters more for pension income than for any other type of retirement income. Most retirees think about state taxes mainly in terms of whether their state taxes Social Security. But pension income is treated completely differently. Pennsylvania does not tax pension income at all. 0. Illinois the same. Mississippi the same. Florida, Texas, Tennessee, Nevada have no income tax at all. Compare that to California, where pension income is taxed as ordinary income at rates up to 9.3%, or New York, where the first $20,000 of pension income is exempt for those over 59.5, but everything above that is fully taxed. Or Minnesota, which still taxes a significant portion of pension income. If you have a pension of $40,000 per year and you live in California versus Pennsylvania, you are looking at roughly $3,700 per year in additional state tax just because of geography. Over a 25-year retirement, that is over $90,000. Same pension, same lifestyle, different state, $90,000. Number 3, the IRS changes how much of your Social Security gets taxed compared to someone without a pension. The IRS uses something called provisional income to determine how much of your Social Security benefit becomes taxable. Provisional income is your adjusted gross income, plus any tax-exempt interest, plus half of your Social Security benefits. For a single filer, if provisional income is below $25,000, none of your Social Security is taxed. Between $25,000 and $34,000, up to 50% of your benefits are taxable. Above $34,000, up to 85%. Here's what nobody tells you. Pension income counts fully toward your provisional income. Every single dollar, no exemption, no offset. So if you have a pension of 30,000 per year, your provisional income starts at 30,000 before you have even withdrawn a penny from your IRA or collected your Social Security. That means pension holders are almost mathematically guaranteed to be in the 85% zone for Social Security taxation. If you have a 30,000 pension and you collect 4,000 in Social Security, your provisional income is 42,000 even with zero IRA withdrawals. You are well above the 34,000 threshold. 85% of your Social Security is taxable. That is $20,400 of additional taxable income just from your benefit alone. Comment with the number 1, 2, or 3. Which of these surprised you the most? I read every single one. Number 4. The IRS changes the math on Roth conversions in ways that work for pension holders, not against them if you know how to use it. A Roth conversion is when you take money from a traditional IRA, pay tax on it now, and move it into a Roth IRA where it grows tax-free forever and never has required minimum distributions. For most retirees, the optimal time to do conversions is the gap years between retirement and age 73. Those years are typically the lowest income years of retirement. But pension holders do not have those low income gap years. The pension starts, the income is fixed. There is no low income window to exploit. So, conventional Roth conversion strategy says you missed the window. Here is the counterintuitive truth. For pension holders, Roth conversions can still make tremendous sense, but the reasoning is different. The reason is not that you are converting at a low rate. The reason is that your pension already locked you into a high effective marginal rate forever, and the future is even worse. When you start taking required minimum distributions at age 73, those RMDs stack on top of your pension. Top of your pension does not stop. Your Social Security does not stop. By age 80, you might be required to withdraw 7% of your IRA balance every year. By age 90, over 12%. If you have a pension of 30,000, Social Security of 24,000, and a traditional IRA worth 400,000, your RMDs at age 73 start at around 15,000. By age 80, they could be over 25,000, and at a depend you are looking at 60 $0 to $70,000 of fully taxable income every year, much of it forced on you. Pension holders need to think about Roth conversions not as a way to find low brackets, but as a way to drain the traditional IRA before the RMDs make the situation impossible. Converting 20s your year in your 60s, SAT 22% is painful, but converting 40 euros a year in your 80s. At the same rate, while also paying taxes on a full pension and fully taxable Social Security, is dramatically worse. Number 5, the IRS changes how Medicare IRMA surcharges hit you. IRMA stands for Income Related Monthly Adjustment Amount. It is a Medicare surcharge that applies when your income crosses certain thresholds. For a single filer in 2026, if your modified adjusted gross income from 2 years ago was above $109,000, you pay a Part B surcharge. For married couples filing jointly, the threshold is $218,000. The standard Part B premium in 2026 is $22.90 per month. With the first IRMA surcharge, that jumps significantly. At higher tiers, premiums can exceed $600 per month per person. Here's why pension holders need to pay attention. Your pension is fixed income you cannot turn off. It contributes to your income every year. If you also have a substantial IRA and you do a Roth conversion, the conversion gets added on top of your pension and Social Security. It is incredibly easy for a pension holder to accidentally cross an IRMA threshold. The 2-year look back is what makes this dangerous. The IRS uses your income from 2 years ago to calculate today's Medicare premium. A conversion you do in 2026 can spike your premiums in 2028 by hundreds or even thousands of dollars per year. If you are a married couple with combined income from a pension and Social Security at $190,000 and you are thinking about a $40,000 Roth conversion, you need to know that it could push you across the IRMA threshold and cost you an extra $2,000 to $3,000 per year in Medicare premiums for 2 consecutive years. That is real money on top of the conversion tax. If you made it this far, hit like. It tells the algorithm to show this to more pension holders who need to hear it. Subscribe and tap the bell for weekly videos. Number 6. The biggest thing the IRS does differently is the way your lump sum versus monthly pension decision affects your taxes for the rest of your life. When you retire from a job with a pension, you often have a choice. You can take a guaranteed monthly payment for life, often with a survivor benefit option for your spouse, or you can take a lump sum, roll it into an IRA, and manage the money yourself. If you take the monthly pension, every dollar is fully taxable as ordinary income every year. Locked in. You cannot defer it. You cannot accelerate it. You cannot avoid it. If you take the lump sum and roll it into a traditional IRA, you have just bought yourself enormous tax flexibility. You decide when to withdraw, you decide how much. You can manage your provisional income. You can stay below IRMA thresholds. You can do Roth conversions. But the lump sum is only better if you actually use that flexibility. If you take the lump sum and just take regular monthly distributions exactly the way a pension would have paid you, you have given up guaranteed income for nothing. You took on investment risk, you took on longevity risk, and you did not capture any of the tax flexibility. There is also a hybrid option that almost nobody talks about. Some pensions allow a partial lump sum and a partial monthly payment. Take part as monthly income to cover your fixed expenses. Take the rest as a lump sum to give yourself tax flexibility for everything else. Most people do not even know this option exists. Ask your pension administrator. Comment the number 1 through 6. Which one surprised you the most? That becomes next week's video. Let me bring all 6 things together because they interact. 1. Your pension is fully taxable as ordinary income. 2. Your state of residence dramatically changes the after-tax value of your pension by tens of thousands of dollars over retirement. 3. Your pension automatically pushes your Social Security into the 85% taxable zone. 4. Your Roth conversion strategy is different. You do not have low-income gap years, but you have a bigger RMD problem coming. 5. Your Medicare ERMAA exposure is constant because your pension floors your income. Any conversion stacks on top. 6. Your lump sum versus monthly decision should be made primarily on whether you will actively manage tax timing, not on rate of return assumptions. Here's the practical reality. If you are a pension holder, the standard retirement playbook does not fit you. The 4% rule was not written for someone with guaranteed income covering most of their expenses. The standard Roth conversion ladder was not designed for someone whose income floor is permanently elevated. You need a different framework. Professional financial planners call it asset liability matching. Match your fixed expenses with your fixed guaranteed income, pension and Social Security. If your guaranteed income covers most of your fixed expenses, your investment portfolio does not need to be conservative. It can be invested for growth, for legacy, for opportunity, because your survival is already secured. Here's a real example. A couple, both 66. Husband's pension pays $36,000 a year. Their combined Social Security is $40,000. Their fixed expenses total $68,000. Their guaranteed income is $76,000. They have $8,000 of cushion before they touch a single investment dollar. They have $450,000 in a traditional 401k. They do not need it for survival. It is for travel, gifts, a buffer. They can afford to be more aggressive. 80% stocks, 20% bonds. Their pension is acting as the giant bond allocation. Adding more bonds to the 401k is double counting. And they have 7 years until RMDs start at age 73. They should do strategic Roth conversions every year. Converting 25 euro a year for 7 years at 22% costs about $38,500 in cumulative federal tax, but it removes nearly $200,000 from the future RMD pile. That saves them well into 6 figures. One more piece that almost nobody gets right: your spouse. When you elected your pension, you probably had a choice between single life, which pays more per month but stops the day you die, and joint and survivor, which pays less but continues to your spouse for life. Most people make this decision based on the monthly payment difference. But when one spouse dies, household expenses do not drop by half. They drop by maybe 20 to 25%. The mortgage is the same. Utilities are mostly the same. If you elected single life, the entire pension stops. The surviving spouse loses one Social Security check and the entire pension. That gap ruins people. Model the survivor scenario before you decide. Also, most private sector pensions do not have a cost of living adjustment. The $36,000 you receive in your own is the same 36. 0 in year 20. But at 3% inflation, it is worth roughly $20,000 in purchasing power. Your investment portfolio is not just for wants, it is also for inflation defense. Here's your action checklist. 1. If you are still working, find out what choices you actually have for your pension. Single life, joint and survivor, lump sum, partial lump sum. Most people never ask. Ask. 2. If you are within 5 years of retirement, sit down with a fee-only financial planner who understands pension taxation. Bring your pension statement, Social Security estimate, IRA balance, and state of residence. Ask them to model the next 20 years, not just the next 2. 3. Do not assume your tax software is catching everything. Most consumer tax software was not built for the specific interaction of pension income, Social Security taxation, IRMA thresholds, and Roth conversion math. 4. Model the survivor scenario. If you are married, look at what guaranteed income would remain if you died first. If that number is well below your spouse's expense floor, the joint and survivor election is almost certainly the right choice. 5. Do not do nothing. The most expensive mistake I see pension holders make is doing nothing. They retire, they start taking the pension, they assume the IRS situation will sort itself out. 10 years later, they are paying tens of thousands of dollars in taxes that could have been avoided. If this video helped you, hit like. Send it to anyone you know who is about to retire with a pension. Subscribe now. The next video is for the people who answered yes to my first question. Comment the number 1 through 6, whichever surprised you most. I read every single one, and the most common answer becomes next week's video. Thanks for watching. See you in the next one.